Imagine waking up one morning to discover that the people with the best information, the ones who usually make their moves months or even years before the public knows what's coming, have quietly vanished from the very investments everyone else still believes are safe. That's exactly what just happened. In the third quarter of 2025, while most investors were fixated on AI stocks, election noise, and inflation debates, Chinese billionaires quietly pulled off a financial maneuver so massive, so deliberate, and so eerily familiar that it should make any investor stop in their tracks. They moved $47 billion out of US stocks and shifted that entire amount into physical gold. Not ETFs alone, not crypto, not bonds. Physical vaulted gold. And the last time they did something even remotely similar? It was 2007, right before the world fell apart. If you're watching this right now, then you're already ahead of most investors because almost nobody is talking about this. The media barely mentioned it. Analysts brushed it off as diversification. But when the smartest, richest, and most well-connected players on the planet all make the exact same move, at the exact same time, in the exact same direction, you pay attention. And before we go deeper, if you find value in this kind of analysis, go ahead and hit that like button and share this video so more people can see what's really happening beneath the surface. Now, let's break down what actually happened. Between July and September of 2025, Chinese investors sold a net $47.2 billion in US equities, the biggest quarterly sell-off since records began in 1998. And the crucial detail isn't just what they sold, it's what they bought. They bought gold, almost the exact same amount. Individually, they purchased over $28 billion in gold bars and coins. Institutions added another $12.6 billion through ETFs and allocated gold. Family offices poured $6.3 billion into privately stored vault gold. Dollar for dollar, the outflow from US stocks matched the inflow into gold. That is not coincidence. That is not rebalancing. That is conviction. And it's not amateur money doing this. These are people like Pony Ma, Jack Ma, Wang Jianlin, names that control corporate empires and have access to information pipelines regular investors never see. Pony Ma scaled down his US positions by 40% and bought over $2 billion in gold. Jack Ma dumped what was left of his Amazon and Meta holdings. Wang Jianlin completely liquidated his US portfolio, 100% gone, and shifted nearly $2 billion into gold. When billionaires sell everything in one country and move to an asset with no counterparty risk, it's not emotional. It's not panic. It's intelligence. It's information. And it's preparation. And here's where this story gets even more unsettling. This isn't the first time they've done it. The only other period that matches this pattern was late 2006 through mid-2007, right before the global financial crisis detonated. They began selling months before the public had any clue the system was cracking. Chinese manufacturers saw US orders slowing before any economic report reflected it. Their banks saw deteriorating mortgage securities long before rating agencies woke up. Their government analysts tracked collapsing demand and liquidity issues in real time. Fast forward to today, and they're sounding the alarm again, but not with words, with actions. Quiet, huge, calculated actions. So what do they see this time? 4 risks, each one big enough on its own to shake markets, but together forming a perfect storm. First, the cooling of the AI boom. The entire world has been betting on Nvidia, AMD, and hyperscale spending as if it can go up forever. But Chinese manufacturers, the ones building the servers, power systems, and cooling units, are reporting something no one else wants to admit. Orders fell 22% in Q3. Big tech is quietly slowing down its AI infrastructure push, and that slowdown won't show up in earnings until early 2026. But by then, the smart money will be long gone. Second, the US debt crisis. At $35.7 trillion and counting, debt to GDP has pushed into territory historically associated with sovereign stress. Smart investors understand math. When your debt climbs faster than your GDP, you're not in a cycle, you're in a countdown. Third, asset seizure risk. Whether it's sanctions, TikTok bans, or geopolitical tightening, wealthy Chinese investors no longer feel safe placing assets inside U.S. jurisdiction. They've seen the U.S. freeze Russian assets. They've seen regulations weaponized. They've seen how fast your investments can become not yours anymore. Gold in Singapore or Switzerland, that's untouchable. Fourth, the dollar's decline as the world's reserve currency. It's not collapsing, but it is eroding. Central banks from China to Poland are buying gold in record amounts, and the BRICS nations are building workarounds to the US-centered financial system. When you connect all these threads, the picture becomes clear. This is not fear. This is positioning. Now, if you're watching this closely, I want to ask you something. Do you think this capital flight is justified, or do you believe it's an overreaction? Drop your thoughts in the comments. I genuinely want to see how people are reading the shift, especially those of you with decades of investment experience. Let's continue. Gold is the destination for a reason. Physical gold has no counterparty risk. No CEO can mismanage it. No central bank can print it. No government can freeze it. It's money that exists outside the system. And historically, whenever the system shows cracks, gold holds and then surges. In 2008, gold doubled while stocks took years to recover. In 2020, gold outperformed every major index. And today, with central banks buying hundreds of tons per quarter, demand is being artificially held near historical highs, while supply remains flat. But here's the part most investors don't realize. Capital flight unfolds in waves. Right now, we're only in wave 1, the smart money phase. From now through early 2026, billionaires, family offices, and sovereign funds exit quietly. Slow enough not to spook the market, but fast enough to protect themselves. Wave 2 hits in mid-2026, when institutions are forced to rebalance as the AI slowdown becomes undeniable. That's when volatility erupts, when large funds dump positions not because they want to, but because they have to. Wave 3 arrives late 2026 into early 2027, when retail investors panic, selling at the bottom while gold is already surging. That is the cycle. Smart money moves first, institutions follow, retail reacts last. And here's the big question: what can you do about it? The first step is simply understanding your exposure. Many people don't even know how much of their wealth is tied to US equities, especially through retirement accounts. If more than half your portfolio is in US stocks, you're essentially betting everything on one outcome, that this time won't follow the same pattern as 1929, 2000, 2007, or 2020. Reducing that exposure to a safer range is not panic, it's prudence. Second, consider building a gold position. That can be physical bars and coins, gold ETFs, or a smaller allocation to miners. The point isn't to gamble, the point is to protect. Third, lighten up on highly overvalued tech, especially companies trading at extreme multiples with no cash flow to justify their price. Chinese billionaires aren't dumping Nvidia and Palantir because they dislike the companies. They're dumping them because they're overextended. Fourth, increase cash. Cash is not trash in a crash. Cash is optionality. Cash is buying power when everyone else is forced to sell good assets at bad prices. Fifth, prepare for the next 24 to 36 months realistically. The timeline suggested by historical parallels points toward cracks emerging in early 2026, institutional selling in mid-2026, and a bottom sometime in late 2026. Whether it follows that exact path or not, the point is clear. This is not a decade-long horizon, it's a short window. And here's the honest truth. Chinese billionaires are not infallible, but they're also not reckless. They didn't panic in 2007, they acted early. They're acting early again now. Maybe the storm won't hit, maybe it will, but ignoring their actions is like seeing a line of limousines leaving a building quietly at midnight and trying to convince yourself it's just coincidence. The choice in front of you is not complicated. You can assume this time is different, keep holding everything, and hope the market keeps rising. Or you can take a measured, disciplined approach, reduce exposure, build protection, increase liquidity, and give yourself the chance to survive whatever comes next. If you've watched all the way through, thank you. These deep dives take time to research, and they're made for people like you who appreciate nuance, data, and long-term thinking. If you found value in this analysis, please hit like, subscribe, and ring the notification bell so you never miss the next breakdown. It helps more than you know. And as always, thanks for watching.